Good morning or afternoon, depending on when you're listening to this. I'm David McClellan, and with me is my business partner, Shamik Mukherjee from Keystone Capital. We regularly have catch-ups with the portfolio directors from asset managers on our panel to quiz them on their view as to what's going on in the world and how this is influencing investment decisions within the portfolios they manage. Given the continued volatility in markets, we thought we would record one of these sessions as a podcast and share this with anyone who may be interested. Today, we are delighted to be joined by James Ward and James Douglas Withers, who are investment directors of Rathbones. Welcome, James and James. So why don't I dive in with our first question? The last 12 months has seen volatility across equity markets, commodity markets, economic data and valuations of companies. So how do Rathbones view the state of global economies in light of this?
Well, firstly, David and Samak, it's been a real pleasure to be part of this. I am looking forward to answering a number of your questions. But I suppose, yes, the world does find itself in a very precarious place. It is on the edge of recession, or at least a period of very low growth. All economies are facing the prospect of this. And the war in Ukraine has showed us recently just how interconnected we really are. But the last 12 months has been very different for each global economy. And I'm going to run through China, Europe, and the US just to show you just how different the last 12 months has been for each of those areas. I'm going to start with China. China, a lot of its issues have really been of their own making. They have adopted a zero COVID policy, and this has caused their economy to slow. In fact, China has been trying to stimulate its economy since 2019. And unlike Western economies, which have been raising interest rates, they have actually been lowering interest rates since then. And last month, cut interest rates by 5 basis points to 3.65. In the past, when China encountered issues, they would just go on basically an infrastructure drive to stimulate the economy. The last one, which happened in 2015. But the Communist Party has agreed that this has been rather wasteful and perhaps money has not been spent where it should be. The lack of stimulus and lockdowns have caused China to abandon its growth target for 2022. And it is a combination of those two factors that have caused new housing starts, a key component of the Chinese economy, to fall by 25%. It is well known that there is bad debt within the Chinese property space. And the Chinese government wants to reduce speculation here. So they are going to allow the bad debt within the space to wash out. This is not so bad for China because it is a closed economy and they have significant offshore reserves if they were to require them. But effectively, this has been a slowdown of their own making. But the good thing for them is they have started engaging with Western vaccine suppliers, which should hopefully end their zero COVID policy. And also actually information coming out today showed the Chinese economy has contracted less than expected in the last 3 months. Turning our attention to Europe. Effectively, Europe came out of COVID 12 months ago, and there were significant logistical issues. We all know about chip shortages, and this has caused some European companies to go on 3-day weeks. Inflation rose because of these shortages, and just as life was starting to return to some sort of normality because of logistics coming right, we were hit by a huge energy shock by the war in Ukraine. Consumers are now significantly worried about their bills and worried about making ends meet. The German government has been very vocal about cutting energy costs, and this is clearly not stimulating the economy. The EU is divided on how they will deal with the problem, and it has once again reared its head, the North versus South kind of two-tier approach. Covering of UK, just as a side to Europe, we're not so dependent on their gas, and so a little bit away from the energy shock, although it is definitely impacting us. And we'll see just how good trusses subsidies help us. But one of our big issues is not getting Brexit done. And so without a real deal with the European Union, it's difficult to see large investment coming into the UK. So effectively, Europe really is at the heart of the energy crisis. Turning to America, very, very different. If you go there, it is not all doom and gloom. 12 months ago, the US was growing at 4%. This growth caused inflation because there was more demand for goods. There was also helicopter drops of money 12 months ago in a post-COVID world. So it has not been unexpected that the government, or should I say central bankers, are tightening in that area. But it is, well, tightening up on rising interest rates. But it is the pace of this which has caused concerns in the US economy. And whilst they are somewhat insulated from the energy shocks, people are feeling very nervous about how high interest rates will rise. So all three regions in the world find themselves in what could be a very low growth environment, but our path to get here has been very different.
Turning to more recent news, inflation numbers came out in both the US and the UK earlier this week and led to a negative market reaction. What do you believe the future path of inflation may look like, and how might this impact markets going forward?
Well, thank you. I think it's worth first pointing out that energy is a huge part of inflation, as we all know, and you can see that on the chart on the left. And really, what this tells us that if energy prices remain around $100 a barrel, that the impact on consumer price index will mitigate over time. The other key component, and this is why markets were so disappointed the other day, is that inflation around the world is made up of more than just the oil price. And the right-hand chart on the previous slide showed that the contribution of different sectors is widespread. And we saw core month-on-month inflation rise 0.6%, which would double the expectation of the market. Now, if you turn to the second chart, you'll see that actually there is a broad range of sectors which contribute to inflation. And when we look at the median numbers, median CPI numbers, we in fact saw the largest increase since the series started in January 1983. So it's quite a widespread phenomenon. This surprise is clearly going to lead to more aggressive hiking by the US Fed. And we saw before the inflation numbers come out that the market was anticipating a 75 basis point rise at the meeting, which is going to be next week at the time of recording. What has happened since these inflation numbers were released is that the market is now pricing in about a 30% chance of a 100 basis point rise in interest rates at the next meeting. And it's almost nailed on certainty that we should see at least 75 basis points at both the next week and the following month's meetings. What this really means is that the implied interest rate in the US could be near 4% by December, if not above. And that's a long way higher than anyone was expecting at the start of 2022, when interest rates were anticipated to be just below 1% at the same time. So markets have got it wrong again. And there's a question, could markets continue to get it wrong? And the answer, I think, has to be yes. Inflation is clearly appearing to be stickier than we think. The variable elements, the fuel and the gas and the food, are coming down, but stickier elements such as rent, as we see on these charts, are still quite elevated. We think they will come down, but perhaps not as quickly as everyone expects. What this really means is that the supply side inflationary impact is falling and the demand side is increasing, and therefore we are waiting really for the impact of interest rates, which always lag, to affect the economy and to have their usual impact of slowing an economy down. It takes time. It takes time for interest rates rises to feed through to things like mortgages and slow consumer demand. So the danger of this, therefore, is that the US Fed will continue to increase rates and more aggressively while waiting for this interest rate rise to impact economies, and therefore will slow down the economy quicker and faster than they intended, and therefore a recession could be deeper and potentially more prolonged. Turning to the UK, headline numbers are down last month only marginally, and that was really on the back of petrol prices falling, which we probably all noticed at the pump. But we know it will continue to rise in the coming months. We have the energy cap, which is increasing, albeit not as high as it could have been. It was £1,277 at the end of last year, and it's about to rise to £2,500. The good news is that the policy introduced by Truss of capping the energy at that level will moderate inflation numbers by around 4%. So it will prevent inflation going to extremely high levels, but nonetheless, it will still be high. And I would say, as an unintended consequence, the reality is that the energy price cap will influence consumers' behaviour and potentially will mean that consumers will not save as much energy as they might otherwise do. So the energy prices may remain elevated because people are not in saving mode. So to summarise, really, in the UK, we anticipate inflation will peak soon and then will fall thereafter. But actually, we've got other factors such as a very tight labour market, which actually, to be fair, is similar to the US. And we have the inflationary impact from people having more money in their pocket because of the energy cap, and also weak sterling, which has an inflationary impact too. So what we anticipate is that whilst interest rates will be slower to rise in the UK, the stickier elements of inflation will persist in the UK, and therefore the UK Bank of England will be forced to continue to hike rates and should in due course reach similar levels to the US. This leads to increased uncertainty in all markets, really, as analysts try to predict the future path of inflation. The outcomes, I think, will be quite wide-ranging and quite hard to predict whether inflation will be significantly higher or lower than markets anticipate. This really leads us to turn back to the usual mantra: we need to pick good quality companies, companies that have good revenues, companies that have good margins and strong competitive positions to withstand any impact of interest rate rises and high inflation going forward. So uncertainty remains, and volatility will be higher, we believe, in the next 6 to 12 months, whilst inflation numbers remain elevated.
So given your bearish outlook, how are you positioning client portfolios?
But we don't see Armageddon happening. It's very different to the emerging market debt crisis of the 1980s, or the tech bubble in the 1990s, or even the financial crisis in 2008, when there was effectively capital destruction. But what we do anticipate is there will probably be a bit of a clean out of businesses, losing that bottom 10%, which actually could be quite healthy. We've all been in a company where you've arrived and thought, oh my goodness, the marketing department's exploded in the last couple of months, or the sales team. Those sort of bubbles haven't had a good clean out since probably 2010 or so. So I think that there will be a good, healthy clean out within potentially the workforce. But I think we need to believe that companies are actually in a pretty good position generally. And what we as managers need to ensure is that there is actually no destruction of client capital. It's a well-known fact that if you invest £100 and you lose 50, to get back to £100, you have to make £100. So we need to use our dynamic asset allocation model to protect clients' capital. And effectively by doing that, we are reducing our equity weighting, but also reducing the risks within that equity weighting. Avoiding the Europe, for example, it's right at the coalface of the issues which we're facing globally. Smaller companies, probably not a place that you want to be at the moment. But if you go out and buy the top 30 companies in the world, you end up with a very nice diversified portfolio. Going back to what my colleague James has said, strong balance sheets, high barriers to entry. Those are the sort of companies that you want to own. The other thing that you want to do is you want to buy protection. So buy those diversifiers, buy those uncorrelated assets, which will behave differently to the equity markets. And also, don't be afraid to clip a coupon. It's been a long time since you've been able to buy a reasonable quality fixed income product and clip a 3, 4, 5, and even 6% interest yield. I think what we need to realize is that as fund managers, we don't always have to drive at 100 miles an hour. There are times when you just need to kind of lift and coast, if that's what I heard on the Formula One the other day. Maybe this is time for a bit of lifting and coasting rather than driving at full speed.
I think it's worth putting a bit of context to the valuation multiples at the moment, and the next chart shows that actually valuations are inexpensive relative to history. So that's a positive point to make. And if we think about the first 6 months of 2022, we saw US markets and European markets fall in the region of 20%. Now, why this is useful, and you can see it from the following chart, is that actually history can be quite helpful, and those investors that have long-term time horizons can withstand these periods of uncertainty. What this chart shows you is that if you were to invest in US equities at any point since 1946, so the last 75 years, and you had a 15-year time horizon, you would never have lost money. Even over a 10-year time horizon, you would have seen positive returns 92% of the time, and even over a 5-year time period, you would have seen positive returns 84% of the time. So it gives us some confidence knowing what markets have done in 2022, and for clients of yours and ours who have those time horizons can withstand the volatility during that journey, i.e. have the correct risk profile, that they can expect and hope to see positive returns with a decent time horizon attached.
Thank you for that update, James and James. So let us briefly explore a few more of the topical issues that you touched upon now. First of all, do you think Russia's invasion of Ukraine has emboldened China and increased the possibility of conflict in the South China Seas? How would Russia-style sanctions on China impact global trade and financial markets?
I think what we could say is our base case is that China's not going to do it today, but it is a goal of the Communist Party in China. So I think we need to realize that it is going to happen at some point in time, and that will inevitably cause tensions. What the Chinese government do like is they do like maintaining the status quo. They do believe that keeping things the same is good for everybody, and so I think that they will find a way to do it in a way that will not spark Western outrage. I mean, my personal view is they won't do what they did a couple of months ago, surround the island and do military exercises. What they'll do is they'll probably go in and cut off the head very subtly, cause a regime change. So I think that it's going to be a lot more subtle than a Putin style takeover. So I can't see the major disruptions like we're seeing happening within Russia, or sorry, within the South China Sea, or because of the South China Sea, should I say?
Sure. So, how do you think Liz Truss's policies will affect UK markets?
James, we couldn't hear you there. So you might need to be a bit closer to the mic.
Okay. Hope you can hear me clearly now.
Yeah.
So what history shows us is it rarely does a change in Prime Minister have an impact on markets. In fact, rarely in the UK does a change in government have a significant impact on markets. So I think the simple answer is no. we yet to see a lot of policy detail. We've obviously seen the energy cap proposals, and we have a budget next week which could explore more issues. But we know that fiscal policy usually has very little impact on many of the FTSE 100 names, albeit it may have more impact on more UK domestic names. What we really would expect fiscal policy potentially to impact is going back to inflation. If tax cuts are introduced, then that could be inflationary long term. That could ultimately see interest rate rises continue. And as we said before, that will be negative for companies. But our broad case scenario is that the UK is more concerned about the global health of the economy, global health of economies, rather than Tory party policy.
So do you think the UK economy can grow above 2%, as the new Chancellor has suggested?
I think it's going to be challenging. I think what we've seen, not in just in the UK, but also in the US, is that central bankers are going to fight this, because central bankers have a desire to fight inflation by increasing interest rates. And if they do that, then that will certainly stifle growth. Added to that, we in the UK have not seen growth at these sort of levels for over a decade, near 15 years. So there's no reason to believe that that will suddenly change. We have to add into that there are a lot of uncertainties in the UK. We have Brexit and the Northern Ireland Protocol. We've got the impact of the furlough scheme, the impact of the energy cap scheme. We've got the potential of the next general election will be clearly on the minds of politicians. So what the new Chancellor will have to consider is the divergence between seeking out growth, which may come at the expense of popular opinion, versus their desire to win the next general election. And you may have seen in the Financial Times this week that there was commentary that the Chancellor wishes to reduce or remove the bonus to salary constraints that have been placed on investment bankers, hoping to bring US bankers and European investment bankers back to London to try and promote growth. A policy which will probably not be very popular and easy for the Labour Party to attack. So the Chancellor and Liz Truss have a very difficult balancing act between that desire for growth and potentially unpopular policies versus their desire to win the next general election.
So our next question, with energy independence taking centre stage, will the West be able to meet its net zero targets?
Warrior myself. I think there are two questions. Energy independence. I think that's on everybody's lips. Germany last year indicated that it wanted to cut its dependence on Russian gas by 50% by 2030. So the firing gun was already sounded, but now everybody's doing it. We will definitely, in my view, be seeing, in order to get energy independence, there's going to be green lights for fracking in the UK. We will see potentially government investment into these small-scale nuclear power plants, which Rolls-Royce has looked at. There's going to be some green lighting on some really blue sky thinking to be able to achieve energy independence. But that'll take time. That'll take at least 5 to 10 years. And once you've done that, maybe there's a chance to change that 2% number, which was which you gave to James earlier, because we'll be able to tell large companies, come build a chip manufacturing plant here. Our power is cheap. We need to invest within ourselves so that we can be a hub to attract people. On the net zero targets, the more that you spend on these large, highly capital intensive spends like nuclear power or fracking, it just means the less money that you've got for green projects. So probably when you're looking at, you've got to look at structural change to the building industry. So making sure all the kind of houses that are built nowadays are highly green. and try and get the consumer, the homes off the grid. I'm sure everybody knows someone who's got an eco home who gets money in at the end of the month. That needs to become the norm, and then we can work on the other bits of the economy, which is industry. But I think it's going to be hard to achieve net zero because of, first of all, the drive for energy independence.
Thank you, James. When you guys switch, could you get a bit closer to the mic? We're losing the first sentence or so of what you're saying. Next question, which I had for you is, what do you think will be keeping CEOs awake at night?
I think in the UK that CEOs will be very worried about the impending recession. That's clearly going to be on their mind and what the impact on revenues will be. I think the other big issues at the moment for them are going to be unemployment. Unemployment at the moment is very low, so finding good quality staff is going to be challenging. The impact of that is clearly wage inflation potentially, so they'll be worried about wage inflation for not only new staff but existing staff, and I think that then feeds into cost inflation as well. So the cost of their goods and manufacturing those goods going forward. So those are the main issues. I think the other issues to think about is also debt levels. Companies which have high levels of debt or due to be refinanced shortly, they will be worrying about interest rates rising and the impact on that. I think what we have to think about when investing in these companies is really looking for companies where they're not so worried about inflation because their product is very much essential rather than discretionary. We're looking for companies which have a low fixed cost basis, so they don't have to worry about cost inflation so much, and looking for companies who have, again, high barriers to entry, can protect those revenue streams, and finally, companies which have, as you can imagine, have little debt or no debt, or certainly no debt that needs refinancing shortly. So I think there's a lot to keep CEOs awake at the night at the moment. Companies do not like uncertainty. I think uncertainty is pretty elevated at the moment. And I think there'll be a few CEOs who are having sleepless nights as they approach the end of year results.
Are there events you foresee that could actually have a positive impact on markets?
Well, of course, the most obvious one in Ukraine, that would, the energy crisis would effectively disappear overnight. But that would only be coupled with a regime change in Russia, which is probably hard to see at this moment in time. I think number two is probably more likely is China ending its zero COVID policy, just freeing up logistics around the world. I read an article a couple of weeks ago that over 8,000 ships are waiting outside Chinese ports to collect goods. Just that pressure valve release would certainly be a boost to markets. And then something like Elon Musk finding a way to crack hydrogen or something like that. If I'm having a bit of fun with it, that would be very nice. Solve the energy crisis. Obviously that would take time to do, but you would know, the Western world would know that it would be shot of a lot of, should we say, the less desirable parts of the world where we're getting our energy from.
Right. Changing the topic a little bit, in our previous discussions, you did not consider cryptocurrency a credible alternative asset class to be included in investment portfolios. Have your views evolved since then?
I think one thing which I need to say is that regulation precludes us from investing in cryptocurrency. So it's currently not a choice that we as fund managers are allowed to take. What I do believe, though, is that as regulation comes on the various cryptocurrencies, that they will become part of portfolios. And I think they're going to become part of portfolios in different ways. So you'll see one which is, some cryptocurrencies are going to be seen, as a store of value, rather like gold, in the alternative space. And other cryptos are going to be seen actually as a trading currencies, rather like US dollars within portfolios. So I think, you're going to see those, the changing of where cryptocurrency is. It's either an investment or something that you buy goods and services for. But I think crypto, at the moment, I believe there are over 5,000 different types of crypto. Clearly, that's totally unsustainable. I don't know what the right number is. Is it 10? Is it 50? Somewhere between that, but it's definitely not 5,000. So I think that, crypto needs to come under regulation a bit more, and then we need to decide which cryptocurrencies we want to trade with and which ones we want to invest with.
So our final question is, with all this uncertainty ahead, would you place your bets on markets being higher or lower by the end of 2023?
We should probably both give you an answer on this. My personal view is I think markets will be higher, but not significantly. I think there's a lot of uncertainty in the world, and therefore, if you were asking me to put a number on it, I would say somewhere in the region of 4 to 5% higher at the end of 2023. But I will probably be wrong because that's the nature of markets.
I a little bit different to James. I think they'll be flat, but I do think that we're going to see a rotation again before the end of the year. Defensive quality is a little bit cheaper than kind of the rest of the markets. I think there'll probably be a little bit of rotation around, and markets will probably end up flat. Well, up. Sorry, will probably be flat from where they are today. But of course, good companies valuations are, they can always get better because they are the companies which are going to protect us.
Thank you, James and James, for taking time today to talk to us and share your insightful views. It's very much appreciated. If anyone who has listened to this podcast have further questions for us or James and James, or would like a copy of the slides, then please do get in touch. Equally, if you'd like to know more about our services, then we would be delighted to hear from you. With that, we would like to conclude this podcast. Many thanks for tuning in, and goodbye.